is rate of stock turnover. And the rate of stock turnover will measure the duration, will measure the number of times that we're able to sell our stock when we buy them. So it is measured in number of times, and it shows that if the number of times is high, then it means that there's a lot of activity. So we can use that to measure whether when management buys their products, they are satisfied with it or they're able to sell it. And we calculate it by dividing the cost of sales by the average stock. So average stock is opening stock plus closing stock divided by 2. So it's a simple average of the opening and closing stock. Now, if we compute it and the rate is high, this is the interpretation. If the rate is high, it means it is good. It means management is efficient and is able to sell their stock several times. And once they keep on selling their stock, it means they're going to generate a lot of revenue. And once they generate a lot of revenue, they can cover their costs and possibly leave some for profit. So when the rate of stock turnover is high, it is good. When it is, Leighton, mute your microphone.
Oh, sorry, sir.
When the rate is low, it is bad. Because when the rate is low, it means that management is unable to sell their stock several times. So management is either dealing in slow moving items, or when they buy it, they are unable to sell it. And because they are not unable to sell it, they will not be able to generate enough revenue. And therefore, it may affect their ability to cover their expenses and profit retention. So when the rate is low, it is bad. So when the rate is too high, it is bad. And the reason is that when the rate is too high, it means the average stock is small. And when the average stock is small, it has implications. What do you think are some of the implications for when the average stock is small? What are some of the implications that you can think of? Can you think of any implication for small average stock? Yes, Anne.
That means there will not be enough to give out. I mean, prices might rise.
Okay, so yes, Theophilus. Once you are the co-host, you answer it when nobody is asked. Theo? Yes, James. Yes, James.
So it means you are unable to meet the demands of your customers.
Okay, that's very good. So it means that the possibility of stock out. So when there's stock out, you are not meeting the demands of your customers. And when they come and you don't have the stock, they come the next time you don't have the stock, the possibility of switch is high. So that will have implications for your business. It is also possible that when you have low average stock, that you are not buying in large quantities. And because you're not buying large quantities, you're not taking advantage of discount. Because if you buy in large quantities, you may be entitled to discount, trade discount. Again, because you have low stock, it means that you may not be taking advantage of economies of scale. So you are operating on a low level, and the advantages that are tied to economies of scale, you are not enjoying them. It could also mean that management is not credible. And because management is not credible, people are not ready to give them products on credit. And because they are not giving them products on credit, they are unable to buy in larger quantities. We also need to understand that there are cost implications associated with buying in smaller quantities, because there are costs associated with reorder. And because there are costs associated with reorder, you may end up paying so much as against another entity that will buy in larger quantities. So these are some of the reasons why when the rate is too high, it is bad. But remember that it is relative. It depends on the type of business that you're operating in. So what is high, what is low is relative and is indicative of the type of business that you are running. Now, where can we get the cost of sales? Where can we get the cost of sales? James, is your hand up? Last week, I asked you to go look for this.
Yes, sir. The cost of sales you get from the income statement, the profit or loss account.
Okay. So the average stock, we're saying there is a simple average of opening and closing stock. Where can we get the opening stock? Where can we get the opening stock? Where can we get the opening stock? Yes, George.
Well, please, in the balance sheet under current assets.
Okay, so if this is 2020, where can we get the opening stock from? Yes, George.
Well, please, you get it from the 2019.
Okay. And then the data of 2020, where will you get the closing stock? Yes, maybe.
It's at the end of, at the close of work for the operating year.
Yeah, but where can you pick it from? Frank. Yes, Lisbeth. Okay, so that is rate of stock turnover. Yes, James.
Is the adjusted trial balance too at the end of the year 2020?
No, but we previously agreed that it will be in the statement of financial position or the balance sheet.
Yes, of course. That one is, but the other the other source.
Yeah, but we're asking where can we get the closing stock from? We said the statement of financial position. Now, as to the if we are in 2020, where can we get the opening stock from? And somebody mentioned 2019 statement of financial position. And I'm asking what about the 2020? And people are giving me something else. Where can we get that from? So for the 2020 section of financial position. Okay, so that's the rate of stock turnover. The next is the average correction period. The average correction period measures the duration within which we collect from our customers when we sell to them on credit. So it measures the duration within which we collect from our customers when we sell to them on credit. Now, it can be measured in days, in weeks, or in months. So if you are measuring in days, you multiply by the number of days in a year. So what I put there is just indicative. You can put the actual number of days in a year, but it won't make much difference. So if you're using days, you multiply by the number of days. If you measure it in weeks, you multiply by the number of weeks. And if you measure it in months, you multiply by the number of months. And we determine the average correction period by dividing receivables over credit sales times number of days, number of weeks, or number of months. But the receivables that we're using is the trade receivables, because we are looking at the duration that we are giving to customers that we have sold to on credit. So we must use only trade receivables, not other receivables. Now, when we are picking the credit sales can be in the state of comprehensive income, or there may be some additional notes. So we need to read the notes of the accounts. So that could also possibly tell us where we can, or what figure we should be using. Now, it is possible that in the notes of the account, additional information may suggest that the 90% of the sales were on credit, for instance. So if you have that information, then it means that you need to take 90% of the revenue figure or the sales figure to be the credit sales. But where there is no information as to the proportion of the sales that were on credit or on cash, then we assume that all the sales were on credit. So we use the number of the total amount that is shown either in the statement of comprehensive income or through the notes. Remember that we are also using receivables, and here the receivables is trade receivables. Okay. Now, when we measure the duration can be long, short, or too short. And as a way of evaluating the average correction period, when the period is long, it means management is inefficient and that they are unable to collect from customers when they sell to them on credit. So when the duration is long, it is bad. However, when the duration is short, it is good. It means management is efficient, they're able to collect from customers when they sell to them on credit. So when the duration is short, it's good. And being long or short depends on the type of business and the industry practice. But when the period is too short, then it is equally bad. Because when the period is too short, it means management is too restrictive, and that they are giving only shorter periods to customers to pay. And because they are giving only short period to customers to pay, customers may find alternative. And once they find alternative, they will stop dealing with this business. And once they stop dealing with this business, your business is gone. That's why when the period is too short, it is bad. Now, being short, too short or long is relative, as I keep on talking to you about. But assuming you have an industry where the industry practice is that customers are given 30 days credit. If you are able to collect, say, 45 days or 60 days, then yours is low. It's way above the industry practice. And that would be a mark of inefficiency, unless you are able to explain why you are given that number of days. But if the industry practice or standard is 30 days, but you are doing, say, 25 days, then it means that you are ahead of that industry. And that could be a good sign. And it will be a mark of efficiency. But if you are giving them, say, 10 days or 15 days, then the customers may decide to switch. And once they switch, your business is gone. So when the duration is short, it is good. When it's too short, it is bad. And when it's long, it is bad. Okay. Any question? Any question? Any question? So activity ratio is not the same as stock turnover ratio. Stock turnover or rate of stock turnover is one of the activity ratios. So it cannot be the activity ratio. Yes, George.
But please, the duration for the calculation of the average collection period, please, is it always the case that it has to be 360, or there are times that you can use 365?
George, you have not been in class, because that was what I mentioned to you. That is the number of days. So you can use 365 for a quarter days. That's okay, but it will not make any difference. And I explained to you that the 360 here is just indicative, but we are using number of days in a year.
Thank you, Doc.
Okay. All right. Please, if you are not asking a question or answering a question, you have to mute yourself. Then we have average payment period. The average payment period measures the duration within which we pay to our suppliers when we buy from them on credit. And just like the average collection period, it can be measured in days, in weeks, or in months. So if you are measuring days, use the number of days in a year. If you measure in weeks, use the number of weeks in a year. And if you measure in months, use the number of months in a year. But we determine the average payment period using trade creditors or accounts payable. And here we're talking about amounts that are owed to suppliers. And we divide that by credit purchases. So it's trade creditors divided by credit purchases, multiplied by number of days, number of weeks, or number of months, depending on your measure. Where can we get the trade creditors? Where can we get the trade creditors? Yes, George.
No, please, in the balance sheet, under current liabilities.
Okay. What about the credit purchases? What about the credit purchases? Where can we get the credit purchases? Where can we get the credit purchases? Yes, Steven.
But on the balance sheet at a grant liability.
The credit purchases.
Yes, please.
Yes, Leonie.
I think on the balance sheet under current assets.
Credit purchases.
Oh.
Yes, Anne.
Please, on the income statement.
Okay, so from the income statement. Very good. But oftentimes, we may not be able to pick the credit purchases directly. So we may have to derive it. Because what we'll see will be the cost of sales. So if you have the cost of sales and you know the opening and closing stock, you should be able to determine the credit purchases. And once again, once you determine the credit purchases, you need to, once you determine the purchases, you need to find out from the notes whether all the purchases were on credit or a portion of it. So if a portion of it, then you need to apply. But if we don't know or there's no information as to the proportion of the purchases that were on credit, then you have to use all the purchases. So you assume that all the purchases were on credit. Last week, we had difficulties with this. And that's why we had to end the class. I asked you to go and read. And it appears that you have not read. It's very, very disheartening. Now, when you are looking at the average correction period and average payment period, if you look at them separately, your judgments may not be right all the time. So what is important is to look at them together, because when you're looking at them, you may determine that there's a gap. And what is important that the gap is in your favor, because there are cost implications if the gap is not in your favor. Okay, write this down. So there are two companies, A and B. There are two companies, A and B. The average correction period for company A is 25 days. Average correction period for company A is 25 days. And for company B is 35 days. So just write ACP, 25 days for A, 35 days for B. Then APP, average payment period for company A is 20 days. And for company B is 50 days. So average payment period for company A is 20 days, and for company B is 50 days. Now, if we have to evaluate these two companies using these two ratios, what will be your assessment for the performance of management? What will be your assessment? Hello? Yes, Anne.
So for A, their average collection period is lower than for B. That means they give the customers owing them an average short time to pay them back. That means it's a good collection period compared to B. And then with the average payment, A has a short time of paying back their suppliers compared to B, which is 50.
Yes. Yes, Bismarck.
Sir, please, with the average collection period, the company A has a shorter period, number of days, and B has a longer. I think for the 25, for the A, company A, it's not good because it's short. Most of their customers can switch, but with the company B, I think they've given them enough time. They will give them enough time that will be an enough time for the collection. So I think for the average collection period, company B is better than A. Then with the average payment period, company B is also better than A.
Yes, Benson.
Sir, with regard to company A, their average collection period is very shorter than the average collection period for company B. Hence, customers will be much comfortable with the company B because of their average correction period from them. And with the regards to average payment period.
Okay, Benson.
Say,
so I gave the class a clue that it is not, you should not be looking at them separately, and I should look at them together. So if you are evaluating this and you have this clue, you see, if you look at the company A, they have to pay within 20 days, but it takes 25 days to collect.
Yes.
So it means that there's a gap there of 5 days, which is not in their favor. It means they have to borrow and pay within 20 days before they collect in 25 days. So they have to borrow and pay interest for at least 5 days. But when you look at company B, they will collect in 35 days, but they have to pay in 50 days. So it means when they collect, they have at least 15 days to invest and make additional income before they pay. So if you're looking at them separately, if you look at the average collection period, you think that A is doing better than B because they collect earlier than B. But I'm saying that don't look at them separately. You have to look at them together. That's what the clue I gave all of you. Any question?
Okay. Thank you, sir, for your submission.
Welcome. Any question, comments? So you should write your phone in. If you don't write your phone in, you can't ask a question or answer a question. Yes, Anne.
So if I'm getting it correctly, because when you asked the question, I was thinking you were saying we stick it individual, but you're saying that means we are supposed to compare average collection period with the average payment period. So if you take it like so side by side, basically.
What I explained to you was that they have individual measures.
Yes.
But if you look at the individual measure, you may not get it right. And sometimes what you have to do is to look at them together. That's what I said. That's why I gave you the example.
Yes.
Okay. So if you're doing the evaluation and you look at them individually, your conclusions will not be right. Because you say that, okay, the average collection period for A is shorter than B. So it means that company A is doing well.
Yes.
Okay. Then if you look at average payment period, you say, oh, company B has a longer period. So company B is able to negotiate for a longer period.
Yes.
But what's the extent to which these two submissions can give you? So that's why I say what you need to do is to look at them together. Okay. And I explained to you that if you're looking at them together, what you should be looking at is the gap and whether the gap is in your favor or it's not in your favor.
Okay. Thank you.
Any other question? Then we can look at, yes, Leonie.
Yes, sir. You made mention of something that when the period is too long, it is bad. So how do you determine when the period is too long?
Okay, so I mentioned to you that it's relative. It depends on the type of business that you are operating. So assuming for this type of industry, it is 40 days for the average payment period, and it is 30 days for the average collection period. So if you have this data, it should tell you that BA is doing far better than A.
Okay.
All right. Then we have fixed asset turnover. Fixed asset turnover is similar to asset turnover, but we're using fixed asset turnover because fixed assets represent the productive capacity of the business. So here we're looking at how you are using your productive capacity or your fixed asset to generate revenue. And it's also measured in number of times. So it's similar to asset turnover. So indeed, asset turnover can also be an activity ratio, and fixed asset turnover can also be a profitability ratio. But essentially what we're looking at is whether the assets or the productive capacity is idle or is being utilized to generate revenue. Now, when the rate is high, it is good. It means that you are using your fixed assets efficiently by using to generate enough revenue. But when the rate is low, it means that your fixed asset may be idle and that you are not using it to generate a lot of revenue. So when it is high, it is good. And when it is low, it is bad. In one of our class, one of the students suggested that when the rate is too high, it will also be bad. And their submission was that when the rate is too high, it means that you're overusing your fixed assets. And if you overuse your fixed assets, they may break down in no time. So when the rate is too high, it's bad. Do you support the students' submission, or you don't support it? And what reasons will you have to advance? Yes, Benson.
So for me, I don't support the students' idea because breakdown of an asset doesn't mean you overuse it. You could underuse it and still it will still break down.
That's not what they're saying. They're saying that if it's too high, it means that you are overusing it. If you are overusing it, it can break down.
Yes, sir. But I think that overusing of the fixed asset cannot causes of it breakdown. You can underuse the fixed asset and it will still break down.
Okay. Yes, James.
So I perfectly agree with him because every fixed asset has its capacity, stated capacity. So when you overuse it beyond that capacity, then it can break down. It costs you more than you gain from overusing it.
The right thing, and people making it look like we are just.
Yes, Peter.
Yeah, thank you. I don't support them actually because if we overuse the fixed asset and it brings higher returns, I don't think it's something that we have to be so much worried about because we have gained from overusing it, so we'll even have money to even buy a new one to replace it. Thank you.
So you're thinking that if you have to use it to produce, say, 10,000 units, but you stretch it to produce 12,000.
And we're able to make the
extra 2,000 can buy a new one when this one breaks down.
Maybe we'll use it over time. And then that 2,000 will accumulate to an appreciable level that we can use. That is what I think anyway.
Okay. Elisa?
Yes, please, I'm in support with their argument that when you overuse the fixed asset, it will break down. I want to cite an example. Using Aboagye, for instance.
Which one is Aboagye?
The motto,
no, go ahead.
Okay. So using the Aboagye, for instance, mostly we see the pure water dispatches overloading the Aboagye in order for them to go once, but mostly you realize that they break down on the road. They have to incur another cost to repair it. And I think it's not beneficial to the company that runs the water production. So when you overuse the fixed asset, definitely you incur reoccurring cost, and that will be like an expense always on the company. So it has to be used averagely and moderately.
So if there's a manufacturer's direction as to how it must be used, you don't have to overstretch it.
Yes, I think that every fixed asset has a quantity. When you buy something, it has a manual that, oh, you can't exceed this limit or you can't go beyond this limit. Every machine has that kind of instruction. And so if you overuse it, it is at your own lost. So kind of.
Okay. Yes, Theophilus.
Sir, I'm of the view that it could be true and it could be false, because it would depend on the asset. If it's a land, maybe the person uses it as a farmland, then later the person converts it into a residential or other purposes. So depending on the fixed asset, then you can state a claim. So that's my viewpoint.
Okay, but we're talking more of the productive capacity, and we said more of machinery.
Oh, okay.
So we have to put it in context, yes. All right. So these are the discussion can continue after the class. But if you look at UGBS, if you have been to the graduate campus, you see they have a generator, a genset, which you use when the half of the main grid goes off. Okay. And for some time, they will send an announcement that we have used it for more than 8 hours or so. So we are going to put it off for it to cool for at least 2 hours or 3 hours. Because if you exceed that maximum, it will break down. And the cost of repair cannot be commensurate with the benefits that we are getting. So that's essentially what the individual was saying. All right. Okay, any question? Now let's look at solvency. Theo, do you still have your hand up, or is it formal? Is it a previous one?
Yes, sir, the old ones. Sir.
All right. So we are evaluating solvency, and solvency has to do with ability to meet long-term obligations. So when it comes to obligation, the obligation can be short-term obligation or long-term obligation. When it's short-term obligation, we are looking at liquidity. But when it is long-term obligation, we are looking at solvency. So solvency has to do with whether the business will survive into the foreseeable future, and that in no time the business will file for bankruptcy because they are having financial challenges. So when we are looking at solvency, we are essentially looking at ability to meet long-term obligation. Now, there are certain signs that you can use to determine whether an entity is heading towards financial difficulty or maybe bankruptcy. Some of them may be short-term, but it is what happens in the short term that may have implications for the long term. And some of the indicators could be when we are having declining profitability and liquidity ratios. So when an entity is experiencing a decline in profitability and liquidity ratios, it can be a sign that you are heading towards financial difficulty. and that you may end up filing for a bankruptcy because of what is happening now. So if we take, for instance, an organization that had return on assets, okay, return on assets, 5 years ago, it was 25%. 4 years ago, it came to 15%. 3 years ago, it came to 2%. 2 years ago, it came to -5%. And a year ago, it became -10%. So you see, the company is experiencing declining profitability. When you make profits, it means you are creating wealth or you're bringing in more assets. So anytime you make profits, the profits are backed by assets. The profits are backed by assets. But when you make losses, it's an erosion of the assets. So anytime you make losses, it's your profit that's being consumed. So if an entity is experiencing declining profitability, and especially when they're making losses, it will get to a point that they may not have access to use to repay their obligations when they fall. So anytime you see an organization experiencing declining profitability, and especially when it gets to losses, then it can be a sign that the entity is heading towards financial difficulty. Remember that we are not saying that if you are doing it, if you are experiencing declining profitability, it means that you are in financial difficulty. No, you see that it could be a sign. Now, if we want to even look at liquidity, and also when you are experiencing declining liquidity, it could also be a sign that you are heading to financial difficulty. And if we want to measure liquidity using the current ratio, we could say that in the last 5 years, your current ratio was 3:1. So for every CD of asset, every CD of liability, you had 3 CDs asset to back it. Then 4 years ago, it came to 2.1:1. Then 3 years ago, 1.2:1. Then 2 years ago, it was 1.1:1. And last year, it came to 0.7:1. So last year, it got to a point that you don't have enough, and that your current liabilities were covered 70%. And you see, this will also have implication when your liquidity is deteriorating. Many businesses may now find it difficult dealing with you. And it also shows the probability of default in the short term. And once you default in the short term, then it may be difficult to attract investments. So when you continuously show declining liquidity, that you're unable to meet your maturing days, then it will have implications for your ability to meet long-term obligations. So declining profitability and liquidity ratios can be a sign that you are heading towards financial difficulty. We can also look at where you have unfavorable debt to equity ratio. When you have unfavorable debt to equity ratio, it can also be a sign that you are heading towards financial difficulty. Unfavorable debt to equity ratio, or when we look at debt to equity ratio, it measures the capital structure. Now, when you have more debt than equity, it could be a sign, or it's a sign that the business has become risky. And because the business has become risky, anytime you're looking for investment, you have to pay a risk premium. And it will also be a sign that the investors or the owners of the business may not have faith in the business, and that's why they are not putting their monies in there. So when you have unfavorable debt to equity ratio, when you're in trouble, it may be difficult for you to attract further investments, and it can be a sign that you are heading towards financial difficulty. We can also look at where you have unfavorable interest coverage ratio. Interest coverage ratio will measure the protection against defaults in interest. So when you have unfavorable interest coverage ratio, it means you're not generating enough to guarantee the interest payments. And when it gets to that point, it may be a sign that you are heading towards financial difficulty. Because when you don't generate enough profit to guarantee interest payments. When you're looking for investment, they may think that you may not be able to pay your interest, and therefore they may deny you. Or if people already have investments in your business, they may want to pull out because the payment of interest will be at risk. So these are some of the signs that you can use to determine whether an entity is heading towards financial difficulty. Okay. Any question? Any question? Now, when we are measuring solvency, we can measure solvency using the income statement, or we can measure solvency using the statement of financial position. So one school of thought suggests that we should use only the statement of financial position. And their position is that when the business has become risky, and this is measured by relative contribution of equity and debt, it means that your investment in the business is at risk. And it doesn't matter whether the entity is generating enough profits to guarantee interest payments. So long as your principal is at risk, you should leave. So potentially ignore the income statement and what it offers, and just look at the statement of financial position and look at how risky your business, your assets have become or otherwise. Now, those who suggest that we should use the income statement, their position is that so long as you are profitable and you are guaranteeing interest payments, the principal may more or less become permanent capital, in the sense that there are a lot of investors that have money and they are only looking for profitable businesses to invest in. So if your business is profitable, if those who are currently who have currently invested in your business, if they decide that they are pulling out, you may find a replacement. So don't consider the state of financial position and whether the investment is at risk or not, but look at whether the business is generating enough profits to cover interest payments. Which of these two will you recommend and why? Which of these two approaches will you recommend and why? Hello, are you there? Okay. Which of these two approaches will you recommend and why?
Prof, I recommend the financial statement. Hello?
Yes, hello. Which one is the financial statement?
The one that says that you look at the profit.
So that's the income statement.
Yeah, sorry, the income statement. Because the income statement will help you know how the firm is making income, more or less to say generating resource revenue. This will help you assess and know whether at the long run the firm is how do you put it? It's viable to make enough profit, at least to meet its expenditure, to beat its expenditure and make profit at the end. So I'll go by that.
Okay. Do you have investments in the men's group?
No, sir.
Hello, Prof. Hello, Prof. But you class me, we are my friend. You say you don't have investment in Peer or men's group.
No,
well, that's what they do. So long as they are able to pay you your monthly
Yes, it's monthly.
You don't have to consider your principal, Abi.
Your principal is based on you do before you invest. You look at their returns, and if you look at the item that is generating more income and the way they are making the returns, it will inform your investment. Well, that is what most of us consider in investing in businesses.
So you're saying that as long as your interest is paid, your principal can go bust.
So you just suppose the returns you make with your principal, and look
I
at it.
suspect that you put your money in men's food. You did?
No problem.
Yes, any others? Okay, so you have to use both. You have to use both. Okay, so one of the measures is the debt to equity ratio. Okay, debt to equity ratio. And we measure the debt to equity ratio by looking at long-term liabilities and owner's equity. But when we talk of the long-term liabilities, remember we have to define what the long-term liability is. And our definition of long-term liabilities is long-term debt. So if you recollect when we're doing the classification for liabilities, we said that the liabilities can be classified into current liabilities, long-term debts, and other long-term liabilities. So the long-term liabilities were broken down into two, long-term debts and other long-term liabilities. And the classification was done that way to help us determine the debt to equity ratio. The liabilities was done this way to, please, hold on 1 second. Sorry. So if you look at the classification we did it so that when we explain to you the capital structure, remember I explained to you capital structure and financing structure, and it's for this purpose. So the capital structure, we're talking about the capital, either equity or debt. So when we're measuring capital structure, we are looking at the financiers of long-term assets. And that is the capital structure. So here we should be looking at long-term debts and shareholders' equity or stockholders' equity, and not the total of long-term liabilities. What are some of the items that may be long-term liabilities, but they are not capital in nature? So we are not classifying them as part of long-term debts, but we are classifying them as other long-term liabilities. Can you give an example? Can you give an example? Can you give an example?
Prof, I'm tempted to say loan.
No, loan is long-term debt.
Prof, please, what about lease?
It's long-term debt.
Oh.
What about debentures?
What?
Debentures, please.
That is long-term debt. You remember when we're looking at it, we mentioned deferred tax. Do you remember that?
Yes, sir. Yes, sir.
Yes, sir.
So that's an example of other long-term liabilities. Yes, Bismarck. Yeah, Bismarck.
Sir, please, can we say post-retirement healthcare?
Hello, Bismarck.
Sir, please, post-retirement healthcare.
Okay, so what about that? So that's a provision. So that is not capital in nature.
Okay, sir.
Okay. Now, so when we measure the debt to equity ratio, I explained to you that it measures the capital structure and leverage. And leverage here has to do with depending on somebody's resources to generate wealth for yourself. And that's why we call debt as leverage. So assuming the entity is making profit of 30%, or the return is 30%, but the interest that they have to pay is 20%. It means you can borrow somebody's money at 20%, generate profit at 30%, pay them the 20%, and you have the 10% to yourself. So you are depending on somebody's wealth to generate wealth for yourself, or you're depending on somebody's investment to generate wealth for yourself. And that is what we refer to as leverage. So if the return is higher than the interest that you're paying, then the leverage is real. But where the interest rate is higher than the return, then it means it's part of your capital that you are using to pay the interest. So assuming your return is 15%, but you have to pay 20%, it means that you have to use part of your capital to pay off the interest. So now, so when we look at it that way, then it means that debt is good. Okay, debt is good. But when you are unable to honor the debt, it will lead to you filing for bankruptcy because the debt may be called. So when you go in for debt, it can be advantageous, but it is risky. And especially where there are various covenants, you're unable to satisfy those covenants. And because of that, you have to now, the debt is called. So you have to now pay immediately. And if you cannot find a replacement and you cannot pay, it means that you have to file for bankruptcy. So debt is good, but it can be risky. Now, there are so many advantages that you can have when you use debt. Debt, for instance, provide a flexible finance. So it's a flexible financing source. So if I want to start a business and the capital requirement is 2 million cedis, I can come to you and say, let's start a business and we will be owners. So I have 50% ownership and you have 50% ownership. So bring 1 million and I have 1 million. Now, once I go by this arrangement, it means that you become part owner and you are stuck with me. Unless in future you decide that you are selling off your shares to me. But if I come to you and say, lend me 1 million to start my business and that I'll pay you later on. Once you lend me the 1 million, I become the owner, the 100% owner. So I'll retain 100% ownership. And once I'm able to generate enough resources, I'll pay you off. And the company becomes my 100%. So in this case, you see that debt is temporary. And especially where the business thrives well and is able to pay off the debt in no time. So debt is flexible because it can be temporary. If you don't use debt, but you use equity, then the individual is stuck with you and may have implications for the future of the business. So that's one of the advantages of using debt. Another advantage of using debt is that the compensation for debt, which is interest, is considered as a business expense. But the compensation for equity, which is distribution of profit or dividends, is not considered as a business expense. And because the interest is considered as a business expense, it is tax allowable or deductible. So it means that before we pay tax, we have considered the interest expense. So because interest is a tax allowable expense, it provides a shield, which is in the favor of the business. So if you want to put it literally, you say that when you use debt, and because of that you have to pay interest, the government will bear a certain portion of the interest for you. Whereas if you're using equity, it is not the compensation, which is dividend, is not tax deductible or tax allowable. So it is paid after payment of tax. So it makes debt very useful. Let me see if we can demonstrate it. So assuming there are two companies, company A and company B. Now, for purpose of our discussion, we are assuming that company A is all equity and company B is all debt. So company A is all, they are going for a facility, and company A wants to bring in equity and company B wants to bring in debt. So if that is the case, if we decide that we are doing profits before interest and tax, and all of these are measured in millions of cedis. So company A is 500,000 or 500 million, and company B is also 500 million. Okay, so company B is also 500 million. So profit before interest and tax, each of them is 500 million. Then interest, because company A is equity, so they are not going to pay any interest. So interest is 0. And company B is going to pay interest because they are using debt. And assuming for purpose of our discussion, the interest is 100 million. Then the profit before tax for company A will be 500 million, and for B will be how much? What will be? Are you following the discussion? Are you following the discussion? Is the class following the discussion?
Yes, sir.
Yes, sir.
Yes, sir, we can hear you. Yes.
You have muted us.
Yes, sir.
Yeah. 6 will be.
Okay. So assuming the tax rate is 25%, how much tax will company A pay?
100.
It will pay how much?
100. 25%. 100.
And company B will pay how much? 25% is 100. Are you sure?
25% is 125.
125.
120.
125.
The second one is
Company
100.
B will pay how much?
100.
100. The second one is 100.
So profit after tax for company A will be how much?
375.
And for company B will be
300.
300.
300.
Okay. Now, because company A is equity, it means you have to pay them dividend. And the compensation, we are assuming that is similar. So they are going to pay them 100 million. And for company B, because it's all debt, so it's 0. Okay. So what will be the profit after tax and dividends? Company A will be what?
275.
275.
And company B will be
300.
Okay. So if you see the appreciation in value, whereas company A is 275, company B is 300. And the difference has to do with the tax components, because the interest which is paid as far as company B is concerned is tax allowable. And because it's tax allowable, it provides a shift. Okay. But company A is all equity. So what they do is that the dividend is paid after the tax. So there's no shift. So you see there's a difference of 25 million. And this is provided by using debt. Okay. So that's what we're explaining in here, that when you use debt, it provides some shift, because the compensation for debt is considered as a business expense, and therefore it becomes tax deductible or tax allowable. Okay. We have also explained to you that when you use leverage, and especially if the company is earning more than the interest, the cost of interest, it adds to the value of the business. And any question? Any question? Any question? Any question? All right. So if we looking at debt to equity ratio, this is how we can evaluate when we are determining the ability to meet long-term obligations and what debt provides. But remember that it is also risky. We can also use the interest coverage ratio. And as I mentioned to you at the beginning, it only measures protection from default on interest. So we measure interest coverage ratio by dividing the profit before interest and tax over interest expense. And it measures the number of times. It is measured the number of times. So when you compute it and the rate is high, it means that you have capacity to pay the interest, and the probability of default is remote. But when you compute it and rate is low, so assuming you compute it and it's 1.5%, it means that you don't have capacity to borrow more, because probability of you defaulting in interest payments is going to be there. It's going to be high. And if you have any small challenge with your business, because you don't have enough profit to cover your interest, probability of default of interest is going to be high. So when we using the interest coverage ratio as a measure of solvency, we look at it whether you are generating enough to cover interest payments. When you compute it and it's very high, then it means that probability of default of interest is low. And again, it also shows you the capacity of the entity to bring in additional debts if they find themselves in trouble, because the probability of or the ability of them to cover interest payments is there. But when you compute it and it's low, then it could also be signed that you don't have enough to cover your interest payment. And it could be a sign that you are heading towards financial difficulty. Okay. Any question? The next one that we want to look at are investment ratios. And investment ratios, as I mentioned to you, may also be seen as profitability ratios, but we separate them because of their specialized nature, and we use them to measure the shares of a business as an investment. And there are several ratios that we can use to measure that. The ratios will include the earnings per share. We can look at the price to earnings ratio, the P ratio. We can look at dividend yield and so forth and so on. Now, when we know, as we discussed, yes, Siba.
Prof, sorry, my network was jamming. I wanted to ask a question. You said something, I didn't get it. With regard to a firm, an equity firm, and a firm that has gone for loan and credit, outside credit, debt. I wanted to find out, you said something about the fact that the firm that has gone for the debt outside can make more profit than, I wanted to find out with regards to the interest issue. Can it be an interest where the interest is more than everything, where they can end up doing everything, and the surplus will be less than that of the full equity business venture? Sorry, sir. That's my question, sir.
I don't understand your question.
Yes, my question is, we compared a full equity firm and a firm that has gone into for debt, like credit. Yes. So I want to find out, don't you have a debt facility which interest can be too much, that can at the end cause the company to run at a loss? Like at the end, when you do a comparison, you find out that the one that has gone for the debt is the one running making loss or not making more profit than the one of the equity. Because you said something like that to clarify, but I didn't get it. That's why I wanted to ask the question.
Okay, so what we're saying is that, you see, when you are making enough or more than enough to cover your interest payments, then it means that you are depending on somebody's wealth to generate wealth for yourself. That's what we say. And that's why it is called leverage. So it's like seesaw. You know seesaw? So it's a lever. It's coming from the term lever. Okay? So if the company is able to make a return of, say, 25%, but the interest is 15%. So once you use the person's resources to generate wealth of 25%, but what you have to pay is 15%, it means you are left with 10 to add to your own. So you are depending on somebody's resources to generate wealth for yourself. And that's what is the leverage. But we said that, so the leverage is seen when the profit that you are making or the return that you are making is more than the cost of capital or the cost of the debt. But if the cost of the debt is higher than the return, then it means it is part of your capital that you are using to service the debt. That's what we said. So assuming your interest is 30%, but you are making 20% or 15%, it means that you need to find additional resources to make up for the 15%. And the additional resources will be your capital. And it's so with a lot of the business that we see around. So you see, when you talk to the SMEs, they will say that we are working for the banks because the interest that they are paying, they are not making a return, which is commensurate with that interest. So you start a business, some people will start a business and you see that it's booming. And in no time, they've collapsed. Because most of them are using monies or they are using capital whose interests are cutthroats. And they are unable to generate enough profits to which is commensurate with their interest. So gradually their principal or their capital will be eaten up. They are using their capital to service it. And in no time, the business will just go under. Or for some of them, you see that they are there, their entire capital is gone. So in actual fact, their net worth is zero or is negative. That's the challenge. Is that okay?
Very okay, sir. Thank you very much, Rob.
Welcome. All right. So we are looking at the investment ratios and we're talking about earnings per share. I explained to you when we're looking at the overview of the business environment and when we're looking at the type of businesses in terms of ownership. We mentioned companies and we mentioned that when it comes to companies and talking about the capital or shares, there are two main types of shares that a company may issue. We said that we have ordinary shares and we have preference shares. What are the characteristics of preference shares? Do you recollect the characteristics of preference shares? Do you recollect the characteristics of preference shares?
Preference.
You don't recollect the. Okay, so one of them was that they're entitled to a fixed rate of dividend. They were entitled to a fixed rate of dividend. So whereas preference shareholders are entitled to a fixed rate of dividend, that of ordinary shares are not quoted. Okay. Now, so when profits are made, you know that the preference shareholders, their dividend is predetermined, but for ordinary shares. So once you pay the preference shareholders, and unless they are participating preference shares, whatever that is left is for ordinary shareholders. So when we are computing earnings per share, we are computing it for ordinary shares and not for all type of shares. Okay, so earnings per share is computed for ordinary shares or common shares. Okay, now to compute earnings per share, when we have the income, net income, which is the profit after tax, we take out preference dividend. Remember, we said that preference shareholders are entitled to a fixed rate of dividend. So if you take out the preference dividend, you divide it by the number of outstanding shares. So the number of outstanding shares are shares that have been issued and are in circulation. So that will give you the earnings per share. So the earnings per share is the profit that is attributable to every ordinary share. Earnings per share is the profit that is attributable to every ordinary share. And it is determined by net income less preference dividends over the number of outstanding shares. Of course, we're trying to simplify the number of outstanding shares because there can be complications. Okay, so we are using number of outstanding shares. Can you take this example? Assuming a company made profits of 2.5 million cedis. Company made profit of 2.5 million cedis. And the preference dividend is 500,000. A number of outstanding ordinary shares is 4 million. Number of outstanding ordinary shares is 4 million. Then what will be the earnings per share? What will be the earnings per share?
0.5.
0.5.
Okay, so 0.5 of a CD or 50 pesos.
Yes, Prof.
Okay, so the earnings per share for this company will be 50 pesos. Okay, let's take another example. So a company has profit of 2 million cedis. But there's no preference shares. The company has no preference shares. And the number of outstanding shares is 500,000. The number of outstanding shares is 500. It will be how much?
4 cedi.
Okay, so the earnings per share will be 4 cedis. So there are two companies, A and B. Company A's earnings per share is 50 pesos per share. and company B's earnings per share is 4 cedis. If you have to invest in these two companies, which of them will you invest and why? Which of these companies will you invest and why?
Of the one with the 4 cedis.
You invest in the one with the 4 cedis.
Yes, bro.
Why?
Yeah, because you
Why?
at the end of the year you make a lot of dividends.
No, this is not dividends. Remember that this is earnings per share.
Yeah, you make a lot. You make 4 cedis on your share.
That is attributable to the business. So you invest in the one with 4 cedis.
Yes, bro.
Okay. Any others? Any others? Yes, Randy.
Yes, Prof. I'll invest with the 4 city because there are no preferences. So we definitely will be paid first. We, the common shareholders, will be paid first.
Okay. All right. But assuming I told you that the market price of company A is 1 cedi, 1 cedi per share, and that of company B is 20 cedis per share, would that change your mind?
Yes, bro.
Why?
You are looking at how much you are going to pay for the share. That's against what you are making at the end of the year. That will inform you your decision.
Okay. So based on this, which one will you buy?
Company B.
You buy company B.
Because I'm taking 10 cedi. I'm investing 10 cedi and I'm making 50% at the end of
no, you said the market price is 1 cedi. 1 cedi.
1 cedi.
For company A.
Yes. So market price for share A is 1 cedi.
Yes.
And at the end of the year, the dividends is 0.5.
No, the dividend, the earnings per share.
Earning per share is 50 pesos.
Yes.
So meaning at the end of the year, I'm getting half the money I bought the share for. So at the end, I'll go in for that one because in 2 years, I'm making back the money I bought for the shares.
Okay. But what about the B?
The B, it will take you 5 years to get back the money you used to buy the share, which is a long period. The payback system is very long.
Okay. All right. So you see, the earnings per share per se is not very useful because before we introduced the market price, all of you were saying that no, I want the company B because the earnings per share is 4 cents. Earnings per share is 4 cents. Okay. But because it does not consider relative cost of the investment, it makes it useless. Okay. So even though earnings per share is one share that one ratio that there's a standard for earnings per share, and you see that is the only ratio that you find on the face of the financial statements, and yet it is not very useful because it does not consider the market price. Now, so if you want to make it useful, then what you do is to bring in the market price, and if you bring in the market price, then we are talking of the price to earnings ratio or the price to earnings multiple. Okay, so to make the earnings per share useful, bring in the market price. And if you bring in the market price as we did, then we're talking about the price to earnings ratio or the P ratio. I'm sure most of you have heard of the P ratio. So that is what the P ratio is all about. And the P ratio is determined by dividing the market price per share by the earnings per share. And remember that it is a multiple. Okay. Now, so based on the information that I provided, what will be the P ratio for company A and what will be the P ratio for company B? What will be the P ratio for company A, and what will be the P ratio for company B? Yes, but you already done that. So tell us. Are you there? Yes, Randy.
Okay, the P ratio for company A will be the 1 over 0.5. So it will be 2. And company B will be 40 over 5. No, sorry, 20 over 4, which will be 5. Yes, if I'm right to figure.
Yes. So for company A will be 2, and company B will be 5. So literally, you are saying that if we invest in company B, it will take you 2 years. If you invest in company B, it will take you 5 years to recoup the original investments. But if you invest in company A, it will take you 2 years to recoup your original investments. So it shows that company B is relatively expensive. However, you cannot just look at the 2 and 5 to make a decision. Because when we are looking at the P ratio and we are considering the market price is not only influenced by earnings. But remember that what we are dividing with is the earnings per share. Okay. Now let me find out from you. Assuming Talo decides that or informs the public that they've discovered 2 more wells and that they are going to mine it for the next 50 years, what will happen to their share price on the market?
It will rise.
It will rise. Okay. So it will rise, but so the appreciation in the market price is not influenced by current earnings. So the market price is influenced by all the available information. So sometimes investors are willing to make a higher or pay for a higher earnings, which will occur in the future. So for instance, the one that we are having with showing in its 5, it is possible that some new information have been given. And because the new information has been given, that's why the market price has gone up. And that investors are willing to pay a higher price now because of the available information. So if you look at the generally some companies, especially those that operate in the high-tech industry, their P ratios tend to be very high. And the anticipation is that they may discover something that will lead to earnings more than quadrupling. So they are ready to pay for a higher price now in anticipation of what the markets will bring in the future. So when you are looking at the earnings per share and the price to earnings ratio, remember that you need to consider a lot of factors and not just the earnings. So if you're only looking at the earnings, then if you look at the P ratio, you will be tempted to say that if you have a low P ratio, then go in for it. But based on the available information, probably you need to go for the one with the high P ratio, knowing that it is a hedge against income or the quality of income that will occur in the future. Okay. Any question? One of the key indicators that people do, especially investors do, is that they want to be able to predict what is going to happen in the future. And because of that, companies will usually have what we call a dividend payout ratio policy. And the dividend payout ratio policy basically considers the distribution of earnings when they are made. So when a dividend payout ratio is set by an organization, it will show the proportion of the profits that is paid out to investors and the proportion that is retained. when you have older people, when older people invest in a company, what kind of ratio do you think that they will expect? And when younger people invest, what kind of ratio would they be looking at? I'm asking you a question.
The older people will prefer higher payout ratio, and then younger people will prefer lower, and once they will be alive to enjoy their investment later.
So what's the reason? Okay, so for older people, most of them may not be on regular income. So they will be depending on their investments. So they will prefer a higher payout ratio. But for younger people, they may have their regular source of income. So when they're investing, they are looking at long term. So they'll be looking at appreciation of shares or capital gains, and also reinvesting so that the company will be able to make enough profits in the future. So they'll prefer a low payout ratio. Okay. Now, so one of the key things that you need to look at is the dividend payout ratio. And it will be one of the key things that people will be looking at when they want to invest. But remember, we have talked about earnings per share. And we said that the earnings per share is the profit that is attributable to ordinary shareholders, which is different from what is actually paid to them. Well, what is paid to them is dividend, and it will depend on the payout ratio. Now, so you can determine the relationship between the dividend that is paid to you and the market price. So if you look at that relationship, we say that you are determining the dividend yield, or simply the yield. So another ratio that we can use, and which is an investment ratio, is dividend yield. Dividend yield, or simply the yield. And it is determined by looking at the dividend per share divided by the market price per share. So this ratio is looking at the value that is returned to you annually as dividends. Remember that the earnings per share is a profit that is attributable to you, but this one is what is paid to you. So we look at dividend yield as the proportion of your investment that is paid to you as dividends on an annual basis. And sometimes what you do is that you can compare this rate with another investment and see which rate is higher, and decide that you are going to invest either in this company or invest in another company, depending on the relationship. Okay. Any question? Now take this example. Take this example. A company has 200,000 ordinary shares. A company has 200,000 ordinary shares, but no preference shares. 200,000 ordinary shares, but no preference shares. Now, profit after tax at the end of the year was 600,000 Ghana cedis. Profit after tax at the end of the year was 600,000 cedis. And the market price per share is 10 cedis. The market price per share is 10 cedis. You are required to calculate the following. You are required to calculate the following. A, earnings per share. A, earnings per share. B, P ratio. B, P ratio. And C, dividend yield. And C, dividend yield. Okay. Who is done? Who is done? Yes, Randy.
Dog, I just want to try. So
Okay.
earnings per share is 3.
Okay. How did you arrive at that?
600. That's a 600 minus 0 over 200,000.
Okay. So the earnings per share will be 3 cedis.
Yes, 3 cedis. 3 cedis. Sorry.
Okay.
Then the P ratio is 10.
P ratio is 10.
No, sorry.
How?
No, sorry on that. Let me just.
PE is 3.33.
How did you arrive at 3.33?
It's the market share, market price per share, which is 10, divided by the earnings per share,
which is 3.
Which is 3.
3.33, sorry.
Great.
Yeah.
Okay. Then what is
the dividend is 0.3.
0.3.
Yeah.
The dividend is 30%.
The inverse of.
Inverse of what?
The inverse of the PE ratio, because I realized that you divide the earnings per share by the market price and get the 0.3.
You say you divide the what?
The earnings per share by the market price.
But the earnings per share is not dividend. We're talking about the dividend per share. We should be using dividend per share.
Yeah, in the so I'm assuming that all earnings were paid out because
we said the payout ratio is 50%. We said the payout.
Oh, okay, I didn't capture that. So that one will be 50% of by 1.5 over 10. So it will be
and it's measured in percentage. You multiply by 100.
15%.
50%.
Yes.
Okay, take us through again.
So you take 50% of the earnings per share so that you can get a dividend payout, and then you divide it by the market price per share, which is 10. Then you get the 15%.
Okay, all right. Any question, comments? Okay, so now let's look at the significance and limitation of ratio analysis. Throughout the discussion, you have seen that ratios are very useful and that we can use ratios to measure the financial strengths and weaknesses of an organization. We have demonstrated that we can use ratios to assess how profitable an entity is. And we can use the profitability ratios, we can use some of the activity ratios, and all of them will measure whether an entity is making a satisfactory return or an entity is not making a satisfactory return, and the implication for the business as we go forward. We have also used ratios to assess the risks that are associated with an investment, whether it's long-term or short-term. So if we look at the ability to meet current obligations or long-term obligation, they measure the risks that are associated with an investment, whether entities will be able to meet those maturing debts or they will be able to meet their long-term obligations. So ratios are very useful. We can use ratios to measure the performance of management. And we have looked at various ratios. And if we want to measure the performance of management, including the activity ratios, we can use that to measure the performance of management, especially when we have data available. So either through the KPIs that have been established or the industry analysis, we can use ratios to measure the performance of management. We can also use ratios to control operations. So anytime companies want to control operations, they will establish the ratios and people make it as reference. So the ratios will be reference points. So anytime you're doing work, you compare what you are doing with the ratios that have been established. And if you are deviating, you will now find ways of coming back. So we can use ratios to actually control operations. So these are some of the significances of ratio analysis. Any question? We must also know that ratios have limitations. And because there are limitations associated with ratios, we have to be careful, or we have to exercise caution when we are doing ratio analysis. So for instance, when we compute ratios, the ratios are computed from the financial statements. And the financial statements are historic in nature. But the decisions that we are taking will have future implications. So if we rely on past data to take decisions that will have future implications, it means we have to exercise a lot of caution. We must also understand that ratios that we compute are primarily quantitative in nature. So 3:1, 5%, 2 times, and so forth and so on. These are quantitative data. But when it comes to decision making, they are qualitative. So if we're using quantitative data to take decisions that will have qualitative implication, it means we have to exercise some caution. So anytime you are taking a decision, remember that, and especially if you rely on ratios, remember that the ratios are quantitative in nature, but the decisions that we are taking are qualitative in nature. We also established that when you're doing ratio analysis, you need a standard against which to do the comparison. And we established that you can use the company own set of data, you can do an interfering comparison, and you can do industry. So even if you are using the company's own set of data, and especially if you are using past data, conditions between two periods may be completely different. And because they are completely different, they may not be comparable. So if you are looking at, say, 2020, and you are evaluating against 2019, 2020 is COVID year. How can you compare COVID year with a non-COVID year? So even though it will be the same business, but they are different. In terms of inflation, in terms of government policies, they may be different. And because of that, we need to exercise caution. When you are doing an interfering comparison, you are doing it with an entity which is completely different because you don't know the policies, you don't know their ethical stance of the other company. So on what basis are you doing the comparison? We said that you needed a policy to represent size, and we have several policies. So if you chose a policy which was not commensurate, it will not be. There could be different growth stages of companies. So one may be at the peak, and another one may be declining. They are not comparable, just looking at the growth stage. So if you look at all of these things, then it means that we do not have a perfect standard. And if we don't have a perfect standard, then we have to exercise caution when we are doing the comparison, because the standard may not be. If you're doing financial statement analysis, it requires skills, and the skills are developed over time. So if somebody who is not skillful decides that they are doing the analysis for you, the conclusions that they arrive may not be wholly accurate. And if you take decisions based on that, it will not be an informed. So these are some of the challenges that are associated with ratio analysis. and in general, financial statement analysis. Okay. Any question? Any question? Okay, so that brings us to the end of financial statement analysis. So next time we'll meet, we'll be discussing budgets. If you have questions, I'd like to take them. Otherwise, thank you for coming.
Hello, sir.
Yes, Peter.
So please, last week you mentioned about I in some of the classes.
We haven't agreed on the nature, so we'll communicate to you.
Okay, sir.
Okay, bye-bye.